Hey, hello investors and future investors. Welcome back to the channel. My name is Tim, and on this channel, I show you how I utilize my portfolio in order to make weekly income. For today's video, I'm going to be showing you some option strategies that can be used if you're trading with a small account. Welcome to Investment Gains. Let's jump right into it. Welcome back, investors. And for those of you visiting for the first time, welcome, future investors. So today's video is going to center around trading with a small account and two option strategies that can be used in order for you to grow your account and make some money along the way. Now, so anyone can use options trading in order to generate some extra income. And it does not matter whether you have a small account or you have a big account. There's option strategies that could suit both. Now, we like to say on this channel, in order for you to trade options and get good at options, you need to get down and dirty with options. That being said, we like to give you a complete walkthrough of each individual strategy. That way you can follow along and you can practice. So for today's video, we're going to be using the Spider ETF, ticker SPY. So now we're going to go ahead and we're going to go to Trade SPY options to your bottom right if you're using a desktop. And then now we're going to go ahead and make sure it says sell and call, and now we're going to go ahead and choose our strike date. Now, as you can see here, SPY is an ETF that has daily expirations. So this allows you to trade even more. However, be very careful of the PDT rule. So let's go ahead and we're going to be choosing August 30th. Okay, now that we have sell and we have call and we have selected our strike date, now we're going to go ahead and we're going to choose our strike price, and we will be looking for a strike price above the current share price. So down here, you can see the share price is trading at around $562 per share. So if we were to trade SPY right now, most of us would not be able to afford it. Okay, so let's go ahead. Now, this is going to be a two-leg option strategy. So let's go ahead. We're going to choose our first leg, which is going to be a sell call. We're going to be going with the 570 strike price, and we're going to go ahead and click into this. Now, how did I choose the 570 strike price? Well, I have been trading for a while and I have developed my own risk tolerance. So whenever I'm doing this option strategy, I usually look for a chance of profitability of 80% or higher. So any price above the 569 fits right into my risk tolerance. So now we're going to go ahead and we're going to flip over to buy and call while maintaining the exact same strike date. The price is going to be above our current strike price, and we will be going with the 572. Now, right before we go into that, the first leg of this option strategy is known as the covered call. If you were to do a covered call on SPY right now, it would cost you upwards of $56,000, which most of us do not have. So now let's go ahead and we're going to choose 572. And previously, we did sell a call, so we received 0.95 or $95. Now we're going to be buying a call, and now we're going to have to pay. So we're going to be paying 0.58 or $58. This option strategy is known as the call credit spread. Now, the call credit spread is an excellent option strategy for anyone trading with a small account, and I'm going to go ahead and explain to you why. So let's go ahead, let's hit continue. And now we're going to choose our amount of contracts. Let's just go for one, and let's hit review. Now, the only difference between trading with a small account and trading with a larger account is your ability to scale based on your capital. So, if you were trading with a larger account, feel free to extend the amount of contracts you have. So, let me break down this trade for you. So, if you were to use the call credit spread on SPY, you would be required to leave a collateral of $200. Now, anyone trading with a small account should be able to afford $200. So, once you do this option strategy and you leave $200 collateral, you will be receiving credit into your buying power right away. That credit is going to be $39. Now, that credit of $39 is yours to keep no matter how the trade goes. That's one of the best parts of this option strategy. You receive a credit right away. And secondly, the collateral you need to use is just very small. So you're able to use a small account in order to do this trade. So how did we come up with the collateral? So your collateral is going to be the distance between your spread, which is going to be the 572 minus the 570, which is going to give us $2. You multiply the $2 by 100 shares and you're going to get $200. So like I said, the call credit spread is perfect for anyone trading with a small account. So let me just break down this trade for you. So come expiration date of August 30th, there's a couple ways this trade could go. Okay, if come expiration date, XPY is trading at any price below 570, then you get to keep your minimum credit of $39. But then now your $200 collateral is now released back to you. And then you could go ahead and do this strategy again for the following week. The other way this trade could go, expiration date once again, if SPY is trading at any price above 572, then once again, you keep your minimum credit of $39. However, you're going to lose your collateral of $200. Now, your total loss is not going to be $200. Your total loss is going to be a difference between $200 minus your credit in which you receive. So once you do this strategy, if you do have losses, it will help minimize your losses. Now, like I showed you earlier, I did choose a chance of profitability of 80%. That also tells you that in order for you to continue growing your portfolio with this strategy, you need to win 4 out of 5 trades. The chance of profitability of 80% is extremely high, so this should be able to help you grow your portfolio. Now, I'm going to show you another option strategy to use if you're trading with a small account. Okay, so for our second strategy that can be used if you're trading with a small account, we're going to be using Marathon Digital, ticker MARA. So let's go ahead to trade MARA options. And now we're going to go ahead and make sure it says sell and then call. And once again, we're going to be choosing our same strike date of August 30th. Now, with this instance, we're going to be choosing our strike price above the current share price. So I'm going to be going with the 20.5 strike price. Now, with the 20.5 strike price, I will have a chance of profitability of 83% or higher, and I will be paid 23 cents or $23. As you well know, each option contract is multiplied by 100 shares. Let's go ahead, hit continue, and we're going to choose amount of contract, which is going to be 1, and we're going to hit review. Now, this option strategy is known as the covered call. And in order to do this option strategy, you must own 100 shares of any stock. Now, the reason why I chose Mara to use this option strategy is because the cost of entry. Mara is only trading for around $18 per share. So if you were to own 100 shares, it's going to cost you less than $2,000. Now, let's go ahead and break down this trade. So the covered call strategy is another option strategy that can be used if you're trading with a small account. So come expiration date of August 30th, there's a couple ways in which this trade can go. So if Mara is trading at any price at 20.5 or higher, then you get to keep your $23 and then you lose your 100 shares. That's what we call options assignment. However, you do lose your 100 shares, but you're going to get the cash equivalent, which is going to be 100 shares multiplied by 20.5, which is going to give you about $2,000 of cash into your portfolio. And that's how you lose with this trade. But this trade is also a win-win option strategy. Now, the reason why you win is that now you get assigned on your shares. You do have upwards of $2,000 into your portfolio. Now, with that $2,000, you could go ahead and do what's called a cash secured put option strategy. Now, for the cash secured put, we're not going to get into that. That's going to be the previous video before this one. I will link it to the top. So, the other way this trade could go is that come expiration date once again of August 30th, if Mara is trading at any price below 20.5, then once again you get to keep your $23 and now you get to keep your 100 shares of this stock. And you're able to do this trade for the following week. And that's how you trade with a small account to keep generating weekly income in order to grow your portfolio. So we did mention how to grow your portfolio by getting weekly consistent income and by utilizing only a small part of your capital. The third and one of the most important caveat of the covered call strategy is what we call stock appreciation. Now, with stock appreciation, let's say you do own 100 shares of Mara, which you acquired at $18.77. Let's just round it off to $19. But come expiration date, you will assign on your shares, and now you're forced to sell your 100 shares at 20.5. Your portfolio is not only going to be up with your premium you received, it's also going to be up the difference between the two, which is going to be an additional $150. So that is one of the hidden benefits of doing the covered call strategy. Now, These are two option strategies that can be used if you're trading with a small account. So thank you guys for watching and let me know if these strategies work for you. So remember, hit the like button, subscribe to the channel for more content like this. But most importantly, if there's anyone that can benefit from this video, feel free to share it with them. And until the next video, keep pushing your investments. But right before you leave, there should be two videos on your screen right now. Feel free to choose either of them. They're both going to help you continue being part of the weekly income team.